Hi, this is Neil Clements, and this is The Real Deal with Neil. What we're talking about today is my personal wealth building strategy that I believe is the ultimate real estate investing strategy for 2025. So let's get into it. So my personal wealth building strategy has three different levers. And so the very first one is active income, which I generate from flipping land and flipping houses. It doesn't really matter to me if it's land or a house or anything in between. I've flipped a lot of different things in my life, from guitars to MacBooks, to other miscellaneous things. But what I like about land and I like about houses is it's much more expensive. So it's the exact same concepts as flipping small things, but it's flipping the big things. And I'm not picky. Like I said, if it's land, if it's a house, I just want to flip something and be able to create a margin. And this is where a majority of my time is spent. This is where my active income comes from, is from flipping. Secondly, we have buying rental properties. And what rental properties, specifically single family rental properties, what I invest in, is what they allow me to do is they allow me to build a bank account for my future self. And secondly, they allow me to write off huge tax reductions due to depreciation, which we'll get more into later in the video. Third is I'm building cash flow by owning seller finance mortgages. And the extent of my portfolio right now is the land that we have. And so with the land that we have that maybe won't sell to a cash buyer, or if we want it to move a little bit faster, then I'll originate seller finance mortgages and collect the payments on those long term. My personal wealth strategy, as you see, has a mix of all. It's income fuels the front end. That income goes into rental properties most of the time, and also can be put into notes as well. Now, I'm not buying the notes. I'm originating them myself through my team. But at the same time, the notes are money that I'm not receiving. So I still look at that as I'm putting money into it. So let's go through these individually and break them down a little bit further for you. So flipping to create income. So when we talk about flipping to create income, everything starts with a good deal. And anybody who flips properties, that may be obvious to, but those of you who maybe don't do it yet, it might not be. The only reason that flippers can go out and create a margin is because we buy properties below market value. There's no secret on that. But there's a lot of people who don't know how deep we have to buy properties. For land, typically we're buying anywhere from 50 to 60% of market value. And this is for the bigger deals, say, 100,000, 500,000, a million, good sized deals. The smaller ones than that, we're not personally doing, but we would have to have even more aggressive margins on it to make sense. For houses, a lot of times we're able to offer between 70 to 80% minus the repairs. And that gets us to a required margin. But with those, as you can see, we're not paying anywhere close to market value. And if for some reason we do play close to market value, it's because we have a value add strategy on the back end. So for example, one that I did recently, I bought a residential property. Now we're converting into a commercial property because of the zoning laws in the city that allowed me to do that. The cash flow from commercial is substantially higher than residential. Therefore, the property is a lot more valuable. So what appeared to the seller to be market value, to me, after the value add, was way far below market value. In land, a similar way to do that is through subdividing, or potentially, rezoning the property, re-entitling the property into a different use. And so a common way we do that is we'll go out and buy, say, like 50 acres and make 5 10-acre lots. We'll buy 5 acres and make 5 1-acre lots. And these are just arbitrary numbers. But to show you that we can still pay market value on some investments, but we can add value. So it's not always that we're looking for properties at half of what they're worth. A lot of times we can double the market value on properties solely because we have value add strategies. Additionally, with these flips, there are times that we decide to hold them a little bit longer. There are times where we decide to renovate them a little bit more to get a higher after repair value. There are also times where we just decide to sell them instantly, whether that's wholesaling, whether that's putting on MLS the day we buy it. Every project is specific, but yet every project is created from being below market value or having a value add strategy. You have to create margins somehow. But the reason we start with flipping to create income and not seller finance or not rental properties is because if we don't have any kind of active income or we don't have any money, then we don't have the money to go out and do investments. And so the way that I look at it, as in my flipping business, I earn the right to go have my passive real estate investments because I have a huge flipping business, doing multiple 7 figures a year. I earn the right to be able to go out and buy my investments, but I don't earn the right until I've actually done it. So that's what it looks like for me to flip to create income. So now let's talk about what I do with that income. What I do with the income is I take it and I put it into single family residential properties. And yes, I do believe some people listening will say, well, put it into apartments or put it in a small multifamily. While that may be true, and while the economies of scale and a lot of other things may be better, I know single family rentals, and so that's what I do. And so I've got pretty decent sized portfolio of them. And what I'm able to do is with flipping, we talked about how essential it is to buy below market value. Rentals, I'm doing the same thing. So I'm creating a spread. For me, I look at rentals in the areas that I invest in, primarily North Texas and Texas Triangle. These investments aren't necessarily cash flowing. In fact, I'm even willing to go negative every single month for some rental investments for the tax write-offs and the depreciation, which we'll talk about in a minute. But with these, I view my rental properties as a future bank account for myself in 10 or 20 years. And so I'm counting on the equity, I'm counting on the appreciation, I'm counting on the principal pay down, and I'm counting on the tax write-offs, and not so much the cash flow. And so you heard how quickly I spatted those off, but those are all the different benefits of owning a rental property or owning an investment property that you should know about. And with my rental property portfolio, I'm continuously improving, I'm continuously top grading, continuously selling. So what I mean by that is a few years back during COVID area, I bought quite a few houses. And a lot of those houses were older. They were old siding houses built in the 1940s and 50s. And I pretty much knew eventually that we would have trouble with some of them. They were pier and beam, so the foundation started moving. They had cast iron plumbing, so the plumbing started to go out. The electrical obviously wasn't up to code or anything close to it. But we were able to get good tenants in it for a few years. We were able to cash flow it for a few years at that time. And we were able to renovate the property while the tenants paid for our monthly mortgage. And so that allowed us to go out and create some spread and sell them in the future, and then reinvest that income into the different properties that we chose to buy from there. And the tax write-off portion of the rental properties comes from a concept called depreciation, which is a write-off that the IRS gives you because your house, in theory, on paper, decreases in value every year, right? There's a way to do that also called accelerated depreciation, in which you can actually take a lot more depreciation year 1, year 2, year 3, or upfront, based upon some items that are going to wear out quicker. And so if you want to look into that, that's a very common strategy that real estate investors use to reduce their taxes, and substantially so. Everybody from a small real estate investor to Donald Trump to, the biggest names in real estate absolutely take accelerated depreciation whatever they can to get their tax write-offs down. And so my objective is to make enough, make a ton of money flipping, put it into rental properties, and then get my tax liability as low as possible, while also building my bank account for my future self 10 years from now, and to have it all done passively via property management so that I spend less than an hour a month even thinking about the rental properties, and my bank account continues to grow over time. They continue to pay off my properties, and I get the tax reductions. So that's why my money goes into rental real estate. And the last thing I do with my money is I hold seller finance notes in the form of, mortgages. And the reason this came about was we had people reach out to us on our land listings and obviously ask if we would seller finance. And there was a time that I was very, very against it. But then I came into realizing how powerful amortization schedules are, and how little principal borrowers pay, especially on like a 30-year mortgage with a quicker balloon, and how much the lender wins in every scenario imaginable. And so I just started asking myself, why don't I just become the bank? And so I did. And so we have several seller finance mortgages, all the way from very low ones like 10 or 20,000, and then some that are above 200,000. And so we're not necessarily picky on who we're financing to, other than the fact that they have to be able to afford the mortgage, have to be able to prove it. They cannot occupy the property until they've paid us off, because it is a business loan, not a residence loan. And they have to have some skin in the game, normally 25% down or more. And we're charging good interest, 10% plus on these properties, and doing as long as an amortization as we can to make the payments affordable, but then also putting a balloon on it to make it reasonable recapture for us, to where we don't have these out for 30, 40 years. And with that, they're very, very lucrative investments. They amplify our cash flow. Where my rental properties are definitely not cash flowing, my seller finance notes more than make up for the deficit on it in a huge, huge way, because they're just drastically more cash flow. Now, they don't keep their value. They decrease in value every month, just like, a mortgage does. It's just paper. But for me, that is my cash flow vehicle, absolutely, when rental properties aren't. And I just love investments where no matter what happens, I win. And flipping, that's not the case, right? If market goes down, then maybe I could be upside down. On a rental property, if they tear up my house, well, then I'm out of luck, right? I got to renovate it. But with a mortgage, holding a mortgage, if they don't pay, then we foreclose and we take it back. If they do pay, then we collect the interest. If they pay off, then we collect a huge payoff. And I've even had some borrowers come back and want to do multiple seller finance loans, especially builders. We work with builders who want to build houses on it. I mean, gosh, the opportunity is endless when you're able to become the bank. And that's what I'm trying to do as much as possible. And I know that all of these strategies, maybe you've heard them all before, but the power in what I'm doing is that we're doing it at scale. We're doing a lot of flips that buy a lot of rentals, that buy a lot of seller finance notes. And all of this knowledge is hugely foundational and might not be revolutionary to a lot of people listening. But I'll tell you, like, this is the strategy that makes millionaires. Like, this is the ultimate real estate strategy, investing strategy for 2025, because you've got to figure out a way to create active income, to put in a passive investment vehicle where you have slow money, you have medium money, and you have fast money. And my version of all of this is flip to make quick money, invest in rentals to make slow money, really slow money, and then makes some additional passive through holding mortgages. So I hope you enjoyed this. If you have any comments or questions, please put them down below, and we'll talk to you soon. Thanks.